Everything changed, and most people didn't even see it coming. Not at first. One moment, the markets were humming along, the global economy breathing in its usual rhythmic pattern. And then, in a single, calculated, quiet, and absolute move, China cut the cord. No preamble, no leaked hints to soften the blow. One directive, one decision, and $1 trillion vanished from U.S. markets like smoke. The damage wasn't just monetary. Something deeper went missing. Trust. Predictability. The sense that despite all the noise, the global economic order still had some rules. That illusion collapsed overnight. What China did wasn't just a policy shift. It wasn't a response wrapped in diplomacy. It was an act of economic war, delivered without a word. The entire flow of Chinese capital into the U.S., once a major artery of global finance, was shut off instantly, permanently, like flipping a switch. There was no time to prepare. No negotiations, no warning signs in the press, no quiet signals to investors. Just a blackout. One moment, China was a major player in American finance. The next, it was gone. And with it, the market cratered. Stocks across every sector plunged. Wall Street's trading floors fell into chaos. Screens bathed in red. Panic spread. And then came the ripple effect. Homeowners watched their retirement accounts shrink. Families realized everyday goods had suddenly become more expensive. CEOs and small business owners recalculated their futures. For the average American, it meant more than just stock volatility. Groceries, phones, TVs, clothing, everything started costing more. The numbers began to creep in. An extra $1,000 per year in basic expenses. Some families would feel it more. Some wouldn't survive it at all. And yet, Beijing showed no signs of regret. No walkback. No apology. No outreach to soften the consequences. In fact, they did the opposite. They accelerated. They didn't just withdraw their money from America. They started planting it elsewhere. China is now channeling its enormous reserves into a new set of partnerships. Regional allies across Asia, infrastructure corridors stretching into Europe, massive investments in Africa, and deepening financial ties with countries once seen as firmly within the American orbit. Even Saudi Arabia, a long-standing U.S. partner, is pivoting. A $50 billion tech fund co-managed by China and Singapore now includes them. A decade ago, that would have been unthinkable. The goal isn't subtle. Beijing is building an alternative to the U.S.-led financial world. A system that doesn't revolve around Washington. A market landscape where the dollar isn't dominant, where America isn't at the center. It didn't start in the headlines. It started in the shadows. On March 17, 2025, the State Administration of Foreign Exchange, China's financial gatekeeper, sent a directive to its major banks and sovereign funds. Effective immediately, no new investments in the United States. That same day, the Ministry of Commerce quietly updated internal documents, designating the U.S. as a hostile investment environment. The language was cold, legalistic, and final. No public announcement followed, no signal to markets, just silence. The world found out only when internal documents were leaked to journalists and verified by international agencies. By then, the exits had already been taken. The capital was already gone. This wasn't a pause. It wasn't a threat. It was a retreat, full and final. And it wasn't just future investments. China began actively pulling its money out. Venture capital funds in Silicon Valley dried up overnight. Deals in Manhattan were canceled mid-negotiation. Chinese backing from major Hollywood productions disappeared. Just a few years ago, China invested over $46 billion annually into the U.S. By 2023, that number had fallen to $2 billion. By 2025, it's not only zero. Chinese institutions are pulling back from existing assets, divesting, selling, exiting. That $1 trillion figure that disappeared from the market, it wasn't theoretical. It was extracted cleanly, deliberately, surgically. Some economists call it revenge. Others call it rebalancing. Professor Kai Dao Zhang calls it something else, a financial knockout. A precise hit to America's most overlooked vulnerability, its addiction to foreign money. Because that's the truth few in the U.S. talk about. For all the patriotic rhetoric, America doesn't fund itself. It hasn't for a long time. Foreign capital has long propped up U.S. growth, fueled innovation, sustained corporate expansion, and underwritten the federal government's ballooning debt. In 2023 alone, the U.S. received $311 billion in foreign direct investment. That money built factories, supported startups, and created jobs. Since the early 1990s, foreign investors have poured over $128 trillion into U.S. financial assets. That stream of outside money is the lifeblood of the U.S. financial system. It props up the dollar, keeps interest rates low, and lets America live beyond its means. But now that lifeline is eroding. As of 2025, the U.S. owes the rest of the world more than its entire economic output. Net external liabilities have crossed 100% of GDP. That statistic alone tells the story of a superpower running on borrowed time and borrowed money. Without foreign trust, borrowing gets more expensive. The dollar weakens, investment dries up, and growth slows. That's not theoretical. It's already happening. Between late 2024 and early 2025, foreign direct investment into the U.S. fell by over a third. Stock purchases from overseas investors dropped nearly two-thirds. Global investors are sending a message with their money. The U.S. no longer feels safe. What's driving them away? Volatility, policy whiplash, a growing sense that America has become unpredictable. An economy where a tweet or a tariff can upend billions in capital. A system where nationalist rhetoric often takes precedence over global cooperation. Inside the Trump camp, some argue this was all part of the plan, a reset, an effort to bring industry back home, to reduce dependence, to reclaim control. But economists warn that it's backfiring. What was meant to build resilience is creating paralysis. International companies are holding off on investments. Boardrooms around the world are weighing their options, and increasingly, they're looking toward China. While the U.S. is closing doors, China is quietly opening them. In 2024, China sold $57 billion in U.S. Treasury bonds, bringing its total holdings to the lowest level since 2009. It was the largest single-year sell-off in almost a decade. Chinese banks, following the lead of the People's Bank of China, have started pulling out of dollar-based transactions with American institutions. That capital is being redirected into Vietnam, Indonesia, India, Saudi Arabia. Even tech and infrastructure projects once dominated by U.S. firms are now being bid on and won by Chinese-led coalitions. The result? A chain reaction. Norway's sovereign wealth fund pulled $1 billion from U.S. tech. Japan's largest pension fund cut its U.S. real estate exposure by 30%. The world is following Beijing's lead. And now, with a $4 trillion corporate debt wall approaching in 2026, the U.S. may find itself without enough willing lenders. That debt needs buyers. Without foreign capital, companies are forced to turn inward and borrow at much higher rates. In 2024, junk bond rates hit 9.6%, up from just over 5% 2 years earlier. That kind of interest is unsustainable. It's a chokehold on growth. Meanwhile, consumers are being squeezed. New tariffs on Chinese goods have pushed prices through the roof. Appliances, electronics, clothing, all more expensive. Retailers are reporting losses. Wages aren't keeping up. The average household now spends significantly more just to maintain the same standard of living. Consumer spending is dropping. Profits are shrinking. Businesses are stuck, unable to raise prices further, yet unable to absorb the losses. Efforts to reverse course are struggling. Trump's 2025 executive order offered tax breaks to companies building factories in the U.S., but investors are spooked. An $8 billion battery plant in Michigan is frozen. A $3 billion robotics facility in Nevada was canceled. Even the $20 billion Intel chip plant in Ohio, once a symbol of manufacturing revival, is now on hold. At the same time, Chinese markets are opening wider than ever. Global investors are being welcomed. New trade routes are being forged. Alternative payment systems are being tested. The dollar's grip is loosening. The U.S. has always believed its place at the center of the global economy was permanent. That belief is now being tested severely. The clock is ticking. Washington must move quickly, restore confidence, rebuild international trust, support struggling industries, lower rates, and pass legislation that works. Because if it doesn't, this won't just be remembered as a bad quarter or a market correction. It'll be remembered as the moment the world shifted the moment the U.S. stopped being the gravity at the center of the financial system. The storm is already here, and it's not circling Wall Street. It's coming from Beijing.